14 years ago, a trader trading futures from his parents' suburban London home shook up the investment world when his computer program set off the flash crash, causing the stock market to temporarily lose $1 trillion.
What the heck is going on down here? I don't know.
All of a sudden here, we started hearing screaming, buy, buy, buy.
The Dow Jones Industrial Average dropped more than 900 points.
Fear came back into the market in a very...
This is the story of Navinder Singh Sarao, the Hound of Hounslow, who will forever be known as the man who cheated Wall Street from a bedroom in his parents' home.
Place that somebody acting alone, without apparently much of a sophisticated background in trading for any of the well-known firms, could cause this kind of disruption.
He allegedly made $40 million using a technique called that there were bad actors during the flash crash. So
I think it absolutely could work because it's the government. It's the government that created this entire environment in the first place, and he's just playing along with it. No, but
Navinder Sarao's story begins with his family's journey from Punjab in India to London in UK seeking better opportunities. They settled in Hounslow in 1982, a location chosen for its affordability due to its proximity to the airport. Nav's parents worked tirelessly in multiple jobs, a testament to their dedication to providing a better future for their children. This background laid the foundation for Nav's later achievements and his relentless drive. He wanted to give back to his parents and make them proud. In 1998, Nav briefly left home to attend Brunel, a mid-tier university where he studied computer science and mathematics. He and his friends were broke, but one of their housemates always seemed to have cash. One day, Nav asked him how he could afford such expensive clothes. The roommate replied and said, "Trading." Nav was intrigued by a roommate who successfully traded tech stocks using his student loan, a risky thing to do since students in the UK would have little money left for food if one trade went badly. However, this encounter sparked Nav's interest in the stock market, leading him to immerse himself in learning everything about trading. Despite initial losses, Nav's early trading experiences were crucial in building his understanding of the markets. Nav was 2 years out of university when he sent his resume to Futex, a small trading arcade with an office in the suburbs, about 45 minutes by train from London's financial district. After graduating, he'd spent a miserable slog doing telephone sales, then taken an admin job on the foreign exchange desk at Bank of America. By the time Futex invited him to the commuter town of Weybridge for an interview, he was unemployed and restless. During the recruitment process, Nav impressed the bosses by answering the mental arithmetic questions faster than they could finish looking them up on a calculator. But he failed to make much of an impression during the interview. He arrived late wearing a suit that looked suspiciously like it belonged to somebody else. He refused to make eye contact and started sentences with mate and brew. Still, he showed signs of potential. Nav might not have known it yet, but he was uniquely well-suited to the job. When he was 3 years old, he learned his multiplication tables after stumbling on a Little Professor electronic game. By the time he got to school, he could multiply longer numbers in his head. While other children scrawled their workings on a piece of paper, Nav found he could hold each step naturally and easily in his brain. He picked up A's and B's without trying, but made sure nobody mistook him for a teacher's pet. He played practical jokes and rarely showed up on time. His tutor recalled a very likable young man, very intelligent, who was full of fun. This led him to a position at Futex, a company far from the glamour of Wall Street.
Nav was always going to be the kind of person that I believe would be legendary, potentially legendary in some way in the future.
Futex's office was above a Waitrose supermarket. The company was one of a burgeoning number of arcades, or prop shops, that sprung up in Britain and the US when trading migrated from physical pits, with their hand signals and colorful jackets, to computer screens. The business model was straightforward, and for a while at least, highly lucrative. Few techs would take on a bunch of wannabe traders and teach them the skills needed to succeed in the markets. Those who thrived were backed with steadily larger sums, while those who failed were cut. Futex made money by taking a share of its traders' profits and a commission on every trade. It was here that Nav began to refine his trading strategies, applying his analytical skills and pattern recognition abilities learned through years of gaming. He noticed certain people would place trades at the same time each day. Once they realized why it is easier to front-run place a trade before they do and make a small profit each time. With enough leverage, this could be extremely profitable. Nav's approach to trading was unconventional. He applied his gaming strategy of observing patterns and developing counter-strategies to the financial markets. He was a keen gamer, ranking in the top 700 of 3 million players globally at the soccer computer game FIFA, which required focus and hand-eye coordination. This method allowed him to identify opportunities that others missed and to execute trades with precision. His strategy was not just about making money. It was about understanding and exploiting the intricacies of the market, effectively becoming a glitch in the matrix. His strategy took on the smartest algorithmic high-frequency traders and beat them. He flipped it around. Knowing how the algorithms were set up, he knew which indicators would lead to big market movements. Nav hired someone to build bespoke software to allow him to essentially fake the market, causing movements in stocks that he could then profit off. This is known as spoofing and is clear market manipulation. Spoofing is a type of disruptive trading behavior that can occur frequently in the commodities markets or where there is the use of algorithmic or high-frequency trading strategies. Spoofing is when a trader places multiple bogus orders that the trader does not intend to have executed and then quickly modifies or cancels those orders before they are executed. The purpose of these bogus orders is to trick other market participants and manipulate the product's market price. The trader seeks to mislead and deceive investors by communicating false price signals to the market to create a false impression of how market participants value a financial product. A false appearance of market depth, with the intent to create artificial price movements. This is exploited by simultaneously executing other real trades that the trader does intend to have executed in an attempt to profit from the artificial price movements that the trader had created, all done in seconds, in multiple cycles that the trader repeats throughout the trading day.
And he also did another term called layering, okay, in addition. It's part of spoofing where you make it look like it's going to be 600, 800, 1200. Hold on, and then he cancels them. He knew at the time, that's why I'm making it simple, that he wasn't going to do those trades, and then he personally profited 40 million.
Not to mention he set up...
Please subscribe if you find this video informative, and please hit that notification bell so you will be notified when we drop another video. Nav wasn't the sole contributor to the flash crash on May 6, 2010, but played a significant role. The ripple effect of several large orders from him and other institutions produced the outcome. The day was going fine until a few hours before 14:32 Eastern Time. Nav began spoofing E-mini S&P futures with 6 sell orders worth $200 million. Nav modified these orders 19,000 times, and that they represented between 20 and 29% of the sell side. When 14:32 Eastern Time hit, the U.S. mutual fund Waddell & Reed sold 75,000 E-mini contracts valued at $4.1 billion. This, combined with Nav's spoofing, negative market sentiment, and other automated trading programs, was enough to send several stock indices plummeting by a record-breaking 9%. The affected markets include the Nasdaq Composite, the Dow Jones Industrial Average, and of course the S&P 500. Billions were made and lost during this crash, which lasted roughly 36 minutes. As expected, when the prices recovered, Nav profited $879,018 thanks to his spoofing. This was a historic yet turbulent day in the financial markets. Navinder Sarao's story about challenging the established norms of the financial world. It's a fascinating story. His journey from a modest background to becoming a significant figure in the trading world is a testament to his skill, determination, and innovative approach to trading. Notwithstanding, what he did was wrong. The line between genius and illegal is so often contextual in the financial markets. Most traders cheat, but Nav was just too careless to look after himself. His story challenges the perception that the financial markets are the exclusive domain of Wall Street elites and sophisticated algorithms. Outsiders can have their moment in the sun, but when you beat the casino at their own game, you pay the ultimate price.